Welcome back to Stock Kong Invest and Analysis, where we look at the market and break down the opportunities.
Like and subscribe!
Tesla's Q4, a disastrous quarter. This article was written by Jonathan Weber. Summary. Pause. Tesla Inc. reported Q4 results beating consensus on both revenue and earnings lines. Despite the beat, TSLA's revenues declined year over year, challenging its high-growth valuation. TSLA's Q4 performance is viewed as underwhelming given expectations and premium pricing. I am Jonathan Weber. I hold a degree in engineering and am a freelance analyst covering primarily value stocks for nearly a decade. I contribute to the investing group Cashflow Club. Article Thesis. Tesla Inc. TSLA reported its most recent earnings results on Wednesday afternoon. The company beat estimates, but results were far from strong in absolute terms. I believe that the stock is unattractive right here, considering the very high valuation, lack of growth, and the fact that Tesla trails Alphabet's Google, Waymo in the robotaxi business. Past coverage. I have written about Tesla here on Seeking Alpha in the past, most recently in October, when I published this article. I was bearish back then, arguing that its valuation was too high relative to how mediocre its gross performance had been. Since then, shares are up slightly, but have underperformed the broad market. With 3 months having passed since my last article on Tesla, and with Tesla reporting its most recent earnings results on Wednesday, it is time for me to update my views on the company. What happened? On Wednesday, following the market's close, Tesla released its Q4 results. These were the headline numbers. Let's start with something positive. Tesla beat the consensus estimate on both lines. That being said, there weren't a lot of things to like in this report, I believe. Revenues were down compared to 1 year earlier, with Q4 2024 not being an especially strong quarter either. In real terms, the revenue decline was larger, of course, which hurts all the more considering Tesla is priced like a high-growth company. Initially, the market reacted positively to the earnings release, but it is likely that shares will remain volatile through Thursday, I believe. Tesla's Q4 just not good enough. While Tesla outperformed expectations, that isn't due to an especially strong operational performance. Instead, it looks like analysts were looking for a disaster, and Tesla did slightly better than that, but most metrics moved in the wrong direction. Starting with business growth, we see that things didn't go too well. Revenues were down by a couple of percentage points compared to 1 year earlier, which was largely due to weak automobile revenues. These dropped by 11% from 1 year earlier, and were down by an even larger 17% on a sequential basis. The big sequential decline was partially due to sales being pulled forward into the third quarter due to the EV tax subsidy change. These results show that Tesla's automobile business is in trouble, I believe. The EV industry keeps growing on a global basis, but Tesla is left out. This is likely due to a mix of reasons, including a stale lineup, Elon Musk being a controversial CEO, and due to ever-growing competition, especially in China. Both TSLA bulls and the company's leadership have been touting the 50% growth per year line for a long time, but it has now, I believe, become pretty clear that that isn't happening anytime soon. The revenue performance of the energy business was better, with sales rising by 25% there, but that wasn't enough to offset the problems in the automobile business. Services revenues were up as well, but with that being the smallest unit, the overall revenue contribution still wasn't too large. I like that the energy business keeps growing, even though results can be lumpy here, but unless Tesla is able to turn things around in the key automobile business, which is still the largest unit by far, there won't be any meaningful company-wide revenue growth. For a company that is priced like a growth stock, that's a problem. Revenues declining isn't the only problem. Tesla also continues to see its margins decline. During the fourth quarter, its adjusted EBITDA margin, which backs out one-time items that would distort the comparison, was down by another 20 base points, dropping from an already rather weak 16.9% to 16.7%. It's worth noting that this was an improvement from 1 quarter earlier, but the year-over-year trend remains negative. When a company faces both declining revenues and declining margins, its profits are dropping as well, of course. In Tesla's case, this meant an earnings per share decline of 60% on a GAAP basis and an earnings per share decline of 17% on an adjusted basis. We can also look at cash flows, which are of course important for a company with big growth plans such as Tesla. Operating cash flows totaled $3.8 billion, down more than 20% from 1 year earlier, with free cash flow coming in at $1.4 billion for the quarter, down by a hefty 30% versus the previous year's quarter. That's around $5 billion to $6 billion annualized, meaning Tesla trades at around 250 times trailing free cash flow, which makes for a free cash flow yield of around 0.4%. When we account for the fact that free cash flows are boosted by share issuance to employees and management, these numbers look even worse, I believe. It is also worth noting that free cash flow was down by 30%, despite capital expenditures actually declining versus 1 year earlier. It's surprising that Tesla chose to invest less in new equipment, considering its big growth plans. Maybe this is due to management realizing that its previous growth plans have become unrealistic. In either case, declining free cash flows despite lower investments are a bad sign, I think. Tesla, is it worth $1.4 trillion? Some other automobile companies are struggling to some extent as well, due to competition, weak economic growth in parts of the world, etc. But other automobile companies aren't valued at $1.4+ trillion, making Tesla a huge outlier. I think that shares are considerably overvalued today. The automobile business is shrinking. The energy business is doing fine, but isn't large enough to offset the headwinds from the auto unit. Margins keep falling, cash flows are worsening, and so on. And yet Tesla trades at approximately 250 times free cash flow, with its trailing 12 months earnings multiple standing at an even higher approximately 400 when we look at Tesla's meager GAAP profit of just $1.88 per share over the last year. Bulls argue that the value of the company doesn't really come from its automobile or energy business, but that it resides in Tesla's robotaxi business or its future robots business. But I think that's a quite optimistic assumption. Tesla continues to trail Alphabet's Waymo, and the fact that it looks like Tesla has now put its safety monitors in a separate vehicle doesn't really make for a lot of progress. Waymo adds new markets constantly, while Tesla has hardly made any progress in rolling out its robotaxi business over the last half year. I don't see why its robotaxi business would warrant a very high valuation of several $100 billion. There is some chance that things ultimately work out well for Tesla, but the fact that Tesla has missed its own deadlines and promises again and again when it comes to robotaxis makes me believe that this is a very risky bet, one I don't want to take. Between the struggling automobile business and the lack of progress in the future businesses, Tesla is not worth $1.4 trillion at all. The current valuation is, I believe, way too high, which is why I remain bearish on Tesla. This article was written by Jonathan Weber. Pause.
Hey viewers, like and subscribe to our channel. We'll keep bringing you more insightful stock analysis. It's going to be wild.